Hi, this is Pete Birchler of StockMarketAlchemy.com, and it is Thursday, February 21st, and I'm going to go over a few charts here today that I think are telling on what the market direction is going to be here. And this first chart is the dollar index, so the US dollar index, and it's something I showed recently on the blog. It broke out of this large triangle period pattern that I've highlighted over the last several weeks here. So yesterday it had a wide range breakout, and one thing I've talked about frequently on the blog over the last few years is when we see markets that develop these large basing periods as indicated by an ADX indicator. So the ADX is a measure of directional strength. So when the ADX is very low for an extended period of time, that means there's no trend to the market. And the longer that type of condition persists, when you do get a new trend or you get a breakout, those trends will tend to be very vertical, and they'll tend to be rather long-lasting, persistent trends. So in this case, we've seen the ADX indicator basically over 3 months below the 20 line, and now we see it at 19 as of yesterday, or just under 19. So another day or two of upward price movement on this, and that ADX will move above 20, which is the textbook signal for a new trend, is when you see the ADX below 20 moving above 20 and price establishing a relatively clear trend direction. So with all of those implications here, I think the suggestion is that the US dollar index is likely to move higher over the coming weeks and months. This line here projects the width of the widest leg of the triangle, so the base of the triangle projected up from the breakout point here, and that would project and move basically up to the highs of July. So we could certainly see a correction corresponding to the size of the correction we saw over the last from September to November, or from April to June of 2012, possibly even more than that. Another interesting feature of this chart here is that the US dollar index typically moves inversely to stocks, and if you see the September 14th low in the dollar index, well, that's when the stocks made their high on September 14th, and then stocks declined into November 16th, and the US dollar index rose into the 19th, and then while we've seen stocks advance to new highs, so that would imply that the dollar index should decline to new lows, but the dollar index throughout December and into January and February never came down and exceeded this September low. So there is a non-confirmation happening here between stocks and the dollar, and oftentimes the currencies will lead the stocks. So in this case, with the strength in the currency and now the breakout, I think those are all some indications that this rally in stocks is probably short-lived here. It's probably going to be a relatively short leg up, maybe ending as of yesterday. Possibly it could continue to move a little bit higher, but I think the tight trend in stocks is probably going to be ending. We're probably going to see, if we do see any higher prices, it's probably going to become a little bit more choppy, a little bit less trendy. And I've gone over those charts recently on there. As far as trading this particular index, you could look at UUP, which is a dollar bull ETF. As far as some of the currency markets, this is the New Zealand dollar, US dollar, so understand that it's only a few days off of a multi-month, over a 1-year high here. So this certainly has potential room to fall substantially if you look at some of these other declines that have happened the last few years. Even compared to some of these other declines here, this could easily fall significantly further. The Aussie dollar, US dollar, again, it is a little bit further off the high. It's been about a month off of its recent high, but again, compared to some of these prior corrections over the last few years, we certainly could see some significant downside there. The US dollar is already moving up strongly versus the Canadian dollar. It's already been up strongly versus the Japanese yen. So the biggest pairing in the dollar index is with the euro. And let's look at a chart here of the euro US dollar for just a minute. So this is actually a weekly chart here, and the euro has rallied pretty strongly against the dollar since July. And what we are seeing currently is somewhat of a divergence between higher highs in the euro and somewhat of a double top in the stochastics indicator. We've now seen the stochastics cross into a sell and the percent D move back below 80 there, which is a nice signal in addition to a break of this trend line here. So those are some indications that we could be seeing the euro start to move down, and with it being the heaviest weighting in the dollar index, obviously you can tell by just looking at the chart that if this is indeed a correction of an overall downward trend in the euro, certainly this could fall substantially further if you look at the size of these down legs. So this could move down for several months with a very large decline. So there, in my opinion, there is easily room for the U.S. dollar index to move up and for these other currencies to fall. I think it'll be interesting to watch what the bond market does here. Bonds have been relative to their bullish trend that they've been in for several years. Bonds are relatively oversold, and sentiment is pessimistic towards the bonds. So that would argue for bonds rallying. However, they are on a historic basis very overbought, and there's been a double bottom type of formation on long-term rates. So I think that'll be interesting to play out. That's one that based off of the correlations that typically occur, I would say we'd probably be set for bonds to rally some in addition to the U.S. dollar, but there may be a point here where the bonds begin to behave differently than they have over the last few years. So that'll be interesting to watch. Another market that's significant in terms of looking at the U.S. dollar is oil. So this is the USO, which is an ETF, and then this is the chart of actual oil prices here. There's a MACD study below here, and there is no divergence on the MACD relative to this late January high. We see it starting to break down out of a tight consolidation here. What I think may be a better trading setup for any type of trade on oil would be for this to rally back up to slight new highs and form a better divergence, somewhat similar to what happened here, where it started down but then poked to a brief new high, then reversed. I think that would be a better trading setup and give a nice divergence here. But oil is obviously the largest consumed commodity on the planet, and basically commodities are priced in dollars, so if commodities fall, the dollar will rise. So this is one we will want to watch to see the possible either trend continuation if there's a breakout above this consolidation level, or does it continue to just continue to fall back underneath this trend line here, or do we get a failed breakout with a more classic divergence before this leg up ends? So in any case, we are relatively close to overbought and could be experiencing some divergence if it pushes slightly higher there. So that'd be another thing to look for when considering the dollar index. So that's really what I wanted to cover for this update. I think that we should be either on the sidelines or considering short positions in the U.S. stock market, and a way to play this from the long side would be to look at bullish U.S. dollar ETFs on either an intermediate to longer term investment type of basis. So have a great day and all the best to your trading.